Every small silver investor must understand something that most people still refuse to see. We are not simply living through another routine market cycle. We are standing at the edge of a structural shift in how money behaves, how credit expands, and how trust either holds or fractures. For decades, the system has functioned on a simple rhythm. When stress appears, rates are cut. When rates are cut, credit expands. When credit expands, asset prices rise. When asset prices rise, confidence returns. And when confidence returns, the cycle continues. But what if that rhythm is breaking? To understand why this question matters, you have to step back from daily price charts and look at the foundation. For over 40 years, long-term interest rates generally moved downward during easing cycles. When short-term rates were cut, long-term yields followed. Traders anticipated policy moves. Bonds were bought aggressively. The curve responded in harmony. That harmony created the illusion of control. Control is everything in a credit-based system. Before you go any further, make sure you like this video, subscribe to the channel, and turn on notifications so you never miss what's coming next. Drop a comment below telling me where you're watching from and what time it is in your country right now. Now, let's return to the topic. When people believe that authorities can suppress long-term yields, they believe borrowing is safe. They believe leverage is manageable. They believe risk can be smoothed out over time. That belief becomes embedded in pension funds, hedge funds, insurance companies, sovereign reserves, corporate debt structures, and household mortgages. Now imagine that harmony starts to falter. Imagine a scenario where short-term rates are cut, but long-term yields refuse to fall in tandem. That single divergence signals something subtle but powerful. The market is beginning to question the long-term purchasing power of the currency itself. This is not noise, it is structural. In previous cycles, easing led to credit inflation. Asset prices inflated in nominal terms. Stocks rose, real estate rose, bonds rallied. Gold rose too, but it rose as part of a broader credit expansion. Liquidity flooded everywhere. But there is another possibility. Instead of credit expanding outward globally, new currency units may remain trapped domestically. Foreign holders of sovereign debt may reduce exposure. Long-term buyers may demand higher yields. If that happens, new money creation does not inflate asset values in the same way. Instead, it begins to directly erode purchasing power. That is debasement. Credit inflation and debasement are not identical. They feel similar at first glance because both involve money creation. But the outcome is radically different. In credit inflation, leverage grows. Asset prices rise relative to consumer goods. Financial markets appear healthy even as imbalances build underneath. In debasement, consumer prices accelerate more aggressively. The currency weakens in real terms. Asset prices may rise nominally, but they fail to keep pace with hard monetary anchors. And that is where silver becomes critical. Silver is not just a commodity. It is a monetary metal with industrial demand layered on top. It is thinner than gold in terms of market depth. It is more volatile. It is more easily squeezed. And when confidence shifts, silver tends to move in violent bursts. Small investors often misunderstand volatility. They interpret sharp declines as failure. They interpret sideways consolidation as stagnation. But volatility in a thin market during structural stress is not weakness. It is pressure building. Open interest in futures markets can reveal something important. When open interest contracts significantly, it often means speculative leverage has been flushed out. That does not guarantee immediate upside, but it does mean that forced liquidation pressure may be largely exhausted. At the same time, physical market conditions can diverge from paper markets. When spot metal commands a premium over futures delivery, it indicates tightness. If that condition persists, hedging mechanisms become strained. Refiners hesitate. Dealers face bottlenecks. The pipeline narrows. This matters because silver's market is smaller and more fragile than gold's. It does not take massive capital flows to move it. It takes marginal shifts in confidence. Now let's simplify something fundamental. Selling is exchanging one thing for another. When you spend currency, you are selling currency. When you spend silver, you are selling silver. The question is not whether you will sell. The question is what you will sell into. Money, at its core, is the most liquid commodity in an economy. Historically, that role emerged naturally in gold and silver because they were durable, divisible, transportable, and scarce. Modern currencies evolved from direct claims on metal into layered credit instruments. The unit of account today is not purely abstract. It has a historical anchor. But decades of credit expansion have layered obligations upon obligations on top of that anchor. If credit confidence weakens, the layers begin to peel away. For a small silver investor, this is not theoretical. It is practical. If the next easing cycle resembles previous ones, silver will likely rise alongside other assets as liquidity expands. But if the next easing cycle fails to suppress long-term yields, and authorities are forced into large-scale bond purchases to control them, the psychology changes. When bond buying becomes overt and persistent, and when it is perceived not as stimulus, but as necessity, trust erodes faster. At that point, silver does not simply track inflation expectations. It becomes a barometer of monetary stress. The gold-to-silver ratio provides another lens. Historically, that ratio gravitated around much lower levels than what we have seen in modern decades. Elevated ratios suggest silver is undervalued relative to gold. Compression in that ratio during a monetary event often signals speculative acceleration combined with monetary repricing. If that ratio were ever to approach historical extremes in a context of bond market instability, it would not merely represent a trade, it would represent a shift in the monetary hierarchy. Small investors must also recognize something else. Regime changes rarely announce themselves gradually. They often appear sudden, even though structural cracks have existed for years. A banking crisis can unfold over a weekend. A sovereign downgrade can ripple through derivatives markets overnight. Liquidity that seemed deep can vanish within hours. The system can appear stable until the precise moment it isn't. That does not mean panic is warranted. It means preparation is rational. Preparation is not about hoarding endlessly. It is about holding liquidity in a form that does not depend entirely on credit expansion to retain value. Silver serves that role for many because it is accessible. It allows smaller investors to participate in monetary insurance without requiring large capital outlays. But holding silver blindly without understanding the macro backdrop is incomplete. You must watch long-term yields during easing cycles. You must observe whether rate cuts still pull the long end lower. You must watch for sustained tightness in physical markets. You must watch whether asset prices rise relative to silver or fall relative to silver. Measuring wealth in nominal currency terms is increasingly misleading. If an index rises 10% while silver rises 25%, the index is falling in silver terms. The measuring stick matters. The critical question is whether we are entering another wave of credit expansion or exhausting the mechanism entirely. If it is another wave, silver rises significantly. If it is exhaustion, silver rises disproportionately. In both scenarios, the path is volatile. There will be corrections. There will be sharp pullbacks designed to shake out conviction. Thin markets amplify both fear and euphoria. Small investors often lose, not because they chose the wrong asset, but because they misjudged the timeline. Structural shifts take time to mature. The system can remain functional longer than anticipated. Shelves can stay stocked. ATMs can continue operating. Daily life can feel normal, even as long-term debt trajectories become unsustainable. The moment of visible fracture often comes after prolonged denial. That is why patience matters. Holding silver is not about predicting the exact month of a crisis. It is about acknowledging fragility in a debt-saturated system where future stability depends on ever larger interventions, and interventions grow less effective over time. Each cycle requires more liquidity than the last. Each rescue package expands balance sheets further. Each easing round compresses yields closer to zero until there is little room left to cut. When cutting short-term rates no longer pulls long-term yields down, the mechanism shifts from guidance to force. Force requires printing. Printing under conditions of fading trust produces debasement. Debasement reprices everything. In that environment, silver is not merely an industrial metal fluctuating with manufacturing demand. It becomes a signal, and signals move fastest when markets are thin. Every small silver investor must pay attention to this, because the difference between another routine inflationary wave and a terminal debasement phase determines not just price targets, but strategy. Do you accumulate steadily during pullbacks? Do you hold through volatility? Do you prepare to exchange silver not for currency, but for productive assets when the time is right? These decisions depend on recognizing which phase we are entering. We are not there yet, but we are closer than many believe. The bond market is whispering. The yield curve is shifting. Liquidity is becoming selective. Confidence is no longer automatic. And when confidence becomes conditional instead of assumed, monetary metals begin to reassert their historical role. Small investors often feel powerless against macro forces, but understanding structural dynamics turns uncertainty into clarity. Silver is volatile because it sits at the intersection of industry and money. When money is questioned, silver responds. When credit trembles, silver amplifies. When debasement accelerates, silver often outruns. You do not need to predict the exact trigger. You need to understand the architecture. If the next easing cycle restores harmony between short and long rates, we repeat the pattern. If it breaks that harmony permanently, we enter something else entirely. And if that happens, the repricing will not be subtle. It will be swift. Now let's go deeper. Most people think inflation is simply rising prices. But rising prices are a symptom, not a cause. The cause is an imbalance between currency supply and productive output, amplified by expectations. In a credit-driven economy, expectations are everything. Businesses borrow because they expect future cash flows to justify it. Consumers borrow because they expect income stability. Governments borrow because they assume continued demand for their debt. That chain depends on belief in long-term purchasing power. When long-term yields rise despite easing, it suggests bond buyers demand compensation for future uncertainty. That is not just a technical anomaly. It is psychological. If policymakers respond by purchasing large quantities of long-duration bonds to suppress yields, they may temporarily stabilize rates. But they also expand the monetary base aggressively. If foreign capital participation declines at the same time, the burden of absorption shifts domestically. Newly created currency then circulates internally, bidding up goods, services, and hard assets. This is where small silver investors must think beyond daily fluctuations. Silver's supply dynamics are complex. A significant portion of annual production is tied to base metal mining. That means silver output often depends on copper, lead, and zinc economics rather than silver price alone. Supply cannot instantly surge in response to rising prices. On the demand side, silver serves industrial uses in electronics, solar energy, medical applications, and advanced manufacturing. Layer monetary demand on top of industrial demand, and you have a dual force dynamic. When monetary stress increases, investment demand rises rapidly. But industrial demand may remain stable or even grow, tightening availability further. Because the silver market is smaller than many realize, relatively modest capital inflows can produce outsized price reactions. Volatility is not accidental. It is structural. Small investors often become discouraged during prolonged consolidations. They question whether the thesis is wrong. But consolidation in a thin market frequently reflects repositioning rather than collapse. Look at historical episodes of monetary stress. Silver rarely moves in a straight line. It moves in stair steps, sharp advances, brutal pullbacks, long sideways phases, then explosive breakouts. Psychology drives these moves. When confidence in currency erodes slowly, gold tends to respond first because it is perceived as the primary monetary anchor. Silver often lags initially. Then, as momentum builds and investors seek leverage to gold's move, silver accelerates disproportionately. The gold-to-silver ratio compresses rapidly during these bursts. If we were to approach a ratio reminiscent of historical norms during a period of overt monetary intervention and yield suppression, it would indicate that silver is being remonetized in the public mind. Remonetization is not declared by decree. It emerges from behavior. People choose what to hold. If they begin preferring tangible metal over digital credit balances, the system adjusts. Now consider the broader debt landscape. Public debt levels relative to GDP are elevated. Private leverage remains significant. Entitlement obligations expand annually. Servicing costs rise when yields rise. If long-term yields remain elevated during easing cycles, debt servicing strains increase. That forces difficult fiscal choices: cut spending, raise taxes, or monetize. Historically, monetization becomes politically easier than austerity. Monetization feeds debasement. Debasement feeds demand for monetary metals. This feedback loop does not require hyperinflation to function. It operates even in moderate inflation regimes if real yields remain suppressed relative to price growth. Real yields matter enormously for silver. When real yields are negative or deeply compressed, holding non-yielding assets becomes more attractive. If authorities cap nominal yields while inflation expectations rise, real yields fall. That environment historically supports precious metals. Small investors must therefore monitor not only nominal rates, but real rates adjusted for inflation expectations. Another dimension often ignored is market structure concentration. Large institutional players dominate derivatives markets. But physical silver is dispersed across mints, refineries, private vaults, and retail holders. If trust in paper instruments declines, demand can shift toward allocated physical holdings. That shift stresses supply chains differently than speculative futures trading. Premiums can widen even if spot prices fluctuate. Retail shortages can appear regionally before global prices reflect the tension. These micro-signals often precede macro headlines. At the same time, it is critical to remain grounded. Not every rate move signals collapse. Not every premium spike signals permanent shortage. Markets exaggerate in both directions. Discipline matters. Small silver investors should avoid leverage that forces liquidation during volatility. Debt amplifies stress. Owning metal outright removes counterparty risk and timing pressure. Timing remains the most difficult element. No one rings a bell at the exact turning point. But structural indicators provide guidance. If we observe repeated easing cycles where long-term yields refuse to cooperate, if bond purchases escalate in scale and duration, if currency weakness accelerates alongside rising consumer prices, and if the gold-to-silver ratio begins sustained compression during that backdrop, the evidence converges. At that stage, silver transitions from speculative asset to monetary signal. Another point often overlooked. Wealth preservation is not the same as wealth multiplication. In debasement phases, preserving purchasing power can feel like outperformance because many nominal assets fail to keep pace. If equities rise 15% while inflation runs at 12% and silver rises 35%, the comparison shifts. Measuring gains purely in currency terms obscures reality. The measuring stick is critical. Small investors should ask, how many ounces does this asset represent? How much tangible utility can it command? Eventually, there may come a moment when exchanging silver for productive assets makes sense. That decision will not be based on headlines. It will be based on relative valuation. If land, businesses, or equipment become undervalued in silver terms during stress, reallocating from metal into productive capital may represent the final stage of strategy. But selling prematurely into currency during debasement would undermine the hedge. This is why patience and clarity are essential. We must also consider global dynamics. Currency competition is intensifying. Trade realignments alter reserve flows. Central banks diversify holdings. These shifts may not dismantle the existing system overnight, but they influence demand for sovereign debt and reserve assets. If reserve demand fragments gradually, the support structure for persistent deficits weakens. That pressure feeds back into bond markets feed into currency stability feeds into precious metal demand. This interconnectedness is why silver investors cannot afford to view price in isolation. Volatility will test conviction repeatedly. Sharp drawdowns may occur even within long-term uptrends. Thin markets exaggerate both optimism and despair. Emotional discipline differentiates long-term success from frustration. Understand that structural shifts unfold in phases. First, denial. The system appears stable. Second, anomaly. Something doesn't respond as expected. Third, intervention. Authorities attempt to restore order. Fourth, adaptation. Markets adjust to new realities. Fifth, regime recognition. The public realizes the old assumptions no longer apply. We may be somewhere between anomaly and intervention. If so, silver remains in accumulation territory for those who understand the timeline. Do not expect straight lines. Expect turbulence. Expect narratives to shift rapidly. Expect temporary strength in the currency during risk-off events. Expect sharp rallies in bonds during panics, even if long-term trends remain unstable. Complex systems do not unwind neatly. But remember this, debt cannot grow faster than underlying productive capacity indefinitely without consequences. When growth slows and debt servicing accelerates, the adjustment must occur through default, restructuring, or debasement. Debasement is politically palatable because it is gradual and opaque. Silver is transparent. It reflects that process. Small investors must therefore focus on structural signals rather than daily noise. Watch long-term yields during easing. Watch real yields. Watch physical market tightness. Watch the gold-to-silver ratio. Watch central bank balance sheets. When these indicators align, the move will not require explanation. It will be obvious. And by then, positioning will matter more than prediction. Every small silver investor must pay attention to this moment, not because panic is imminent, but because structural change rarely offers extended warning once it accelerates. Whether we face another wave of credit expansion or the exhaustion of the mechanism itself, silver stands at the crossroads of industry and money, volatility and stability, speculation and preservation. The difference between noise and regime shift lies in the bond market, in real yields, in trust. Watch those signals carefully. Accumulate with discipline. Avoid leverage. Measure wealth in real terms, not nominal illusions. And when the time comes to act, let clarity, not emotion, guide your decision.